When a financial giant like Morgan Stanley makes a big call on a market, people tend to listen. And their latest analysis on India is definitely turning some heads. They're seeing a major rebound on the horizon. But is it real, data-driven optimism, or is it just hype? Well, let's break it down.
So this is the big headline, right? A rebound is coming. It's a really bold forecast that could mean huge things for the Indian market. But what are they actually seeing that makes them so confident? Let's peel back the layers and really look at the evidence behind the claim.
So here's how we're going to tackle this. First, we'll dive into the good news, the reasons for all this optimism, the full bull case. Then, we've got to be realistic, so we'll inject a dose of realism and look at the pretty significant risks. After that, we'll connect the dots to see why any of this matters to you. And we'll wrap it all up with a simple watch list so you can track this whole story as it unfolds.
All right, section 1, the bull case. So what's actually fueling this optimistic fire? Let's dig right into their core arguments.
The central idea is actually pretty simple. The worst might be over. Morgan Stanley sees the big economic tides turning in India's favor. Think of it like this. You've got the government boosting the economy with spending, that's fiscal policy, and at the same time the central bank is making it easier to borrow and grow, that's monetary policy. And it looks like both are finally starting to push in the same direction.
And look, this isn't just about some temporary bounce. They're pointing to some powerful, long-term shifts happening under the surface. India is becoming less dependent on foreign oil. It's grabbing a bigger slice of the global export pie, and it's getting its own financial house in order. That last point is a really big deal, because it could lead to lower interest rates, which is basically jet fuel for business investment and growth.
Okay, so that's the sunny outlook. But as we know, every forecast has a few clouds on the horizon. A recovery is never just a straight line up, so let's talk about the key risks that could throw this entire thesis off course.
And this is the million-dollar question every smart analyst is asking, right? The optimistic case sounds fantastic, but is it guaranteed? Absolutely not. No way. So let's take a serious look at the counterarguments. And this slide lays out the core conflict perfectly. On the left, you've got all these strong fundamentals pushing for growth, but on the right, you see the problems. First, market prices are already high, what analysts call stretched valuations. This means a lot of this good news might already be baked into the price. Plus, India hasn't really caught that massive AI-driven stock boom that we've seen in other countries, and that could hold it back. So, we've seen the bull case in the bear case. But why does any of this actually matter to you? Let's connect these big picture, abstract ideas to what they really mean in the real world.
This report is basically a masterclass in what's called the macro-micro connection. And here's the key takeaway. A growing economy is like a rising tide. It doesn't just lift a few fancy yachts, it lifts all the boats. When the whole economy does well, the entire market can get a boost. And really grasping that connection is what separates a good analyst from a great one.
So, when you hear analysts talking about a turning point, that's your cue to really pay attention. It's basically code for the rules of the game are shifting. The potential for big gains is going up, but so is the risk of things going wrong. This is the exact moment when sharp analysis becomes more important than ever.
Now for the final section. Let's make this practical. How can you track this thesis for yourself? We're going to build a simple watch list so you can follow along and draw your own conclusions from the data.
This is probably the most important takeaway from this whole thing. The report's positive outlook is not a blank check. It is completely conditional. It depends entirely on whether the economy actually behaves as expected. If some of the key indicators start flashing red, this entire recovery thesis could fall apart, and fast.
So what should you watch? Just focus on these 3 things. First, GDP. Is the economy actually growing faster? Second, real interest rates. That's just the main interest rate minus inflation. If it's low, it's like fuel for the economy. And third, corporate earnings. Are companies actually making more profit? If these 3 are pointing up, the recovery thesis looks strong. If not, it's time to be cautious.
Okay, here's a little challenge to put all this into practice. Take this framework and apply it. Choose 3 big, well-known Indian companies. think about how a strengthening economy would specifically benefit them. Then, flip it around. Think about the risks. What could derail their growth even if the macro picture looks great? This is how you move from just theory to real-world application.
So there you have it. Morgan Stanley has laid out a compelling map for a rebound, but it's a road that's full of potential roadblocks. The thesis is on the table, the arguments are clear, and now we just have to watch the data. The big question isn't just if the recovery will happen, but who will be right when the dust settles, the bulls or the bears?